Hey everyone, welcome back to Corporate Decoder, the place where we peel back the layers of corporate finance to see what is really going on. And today we're diving into iBio Incorporated's latest filing. Get ready because this one has some interesting shifts and a serious cash infusion to talk about. Alright, so iBio Incorporated is filing an amendment to their quarterly report for the period ending the 30th of September 2025. So what does this actually mean? Well, it is a bit like finding a typo in your homework. After you've already handed it in, they're just correcting a small detail in an exhibit that was filed before. But the core information is what we're here for, the financial peek into the company's progress. Let's jump right into the numbers on their balance sheet. As of the 30th of September 2025, they had about $28 million in cash and cash equivalents. That is a big jump from about $8.5 million back on the 30th of June 2025. They also have about $21.5 million in investments in debt securities, so they're not just sitting on cash, they're also putting some of it to work. Overall, their total assets grew significantly from about $23 million to over $64 million in just a few months. On the flip side, their liabilities stayed relatively stable, with total liabilities at around $8.3 million. But look at their stockholders' equity, that is where the real story is. It jumped from about $14.8 million to over $56 million. This big leap is largely due to those stock issuances we'll talk more about. It means the owner's stake in the company has grown substantially. Now let's talk about how they're actually making money, or in this case losing it for the 3 months ending the 30th of September 2025. Their revenue was about $100,000. Not setting the world on fire, but it is revenue. However, their operating expenses were significantly higher at over $6 million, leading to an operating loss of almost $6 million. This is a common story for biotech companies constantly investing in the future. Their net loss for the quarter was about $5.7 million, which is more than the $4 million loss in the same period the previous year. But remember that big increase in cash on the balance sheet. It tells us they had a plan to fund these losses, and that plan involved selling stock. And speaking of stock, get this, their weighted average common shares outstanding surged from around 8.6 million in the prior year period to over 52 million shares for the 3 months ended the 30th of September 2025. This massive increase in shares directly reflects those significant stock sales and warrants being exercised. It means the pie got a lot bigger and existing shareholders' pieces got smaller proportionally. The loss per S-share reflects this, jumping from a loss of 46 cents to 11 cents per S-share. Looking at the statement of stockholders' equity, we see that huge increase in additional paid-in capital. This is the money investors paid for stock above its par value, and it ballooned from about $347 million to almost $394 million. This is the direct result of those stock offerings filling their coffers. In their cash flow statement, we see they used about $5.7 million for operating activities. This aligns with their net loss and shows that their core business operations are still burning cash. Their investing activities show they spent about $21.5 million on debt securities, which is a significant chunk of their cash moving into more stable investments. But the real action is in financing activities. They brought in about $46.7 million. This influx of cash comes from selling their stock and warrants. It is what is keeping the lights on and funding their research and development efforts. This is crucial because as we saw, their operating activities are still consuming cash. Let's touch on those investments in debt securities. These are essentially short-term government-backed IS mature by 2026 and 2027. They bought about $21.5 million worth of these. It is a smart move, reducing risk and keeping some funds liquid while earning a modest return. Now let's dig into some of the key transactions that explain these numbers. In December 2023, they had an offering that brought in about $4 million after fees. They sold stock and warrants. They keep selling stock and warrants because that is how they fund their research and development. It is a constant cycle in this industry. Then in March 2024, they closed another deal, raising about $14.1 million in net proceeds. Again, stock sales and warrants. This is how they get the capital to keep going. They also have this at the market agreement, which allows them to sell stock gradually. In the 3 months ending the 30th of September 2025, they sold over 300,000 shares through this agreement, bringing in about $219,000. It might not sound like much, but it is a steady stream of funding. Then things really heat up in January 2025. They sold about 240,000 shares to their officers and directors for about $655,000. This shows confidence from within the company. And here is a big one. On the 29th of April 2025, they entered into an agreement to get holders of old warrants to exercise them at a lower price. In return, they issued even more warrants. This generated about $6.2 million. It is a way to get cash now and manage outstanding warrants. But the real headline is that August 2025 underwriting deal with Leerink Partners. They sold pre-funded warrants and other warrants, bringing in a whopping $50 million before expenses, and potentially another $50 million if those warrants get exercised. That is why their cash balance exploded. This is a massive capital raise for them. They also have ongoing warrant activities for previous deals, like the Wainwright one from December 2022. Some of those warrants had a reduced exercise price in April 2025, which generated cash at that time. Let's look at the impact of all these share issuances on earnings per S-Hair. Because they sold so many more shares, the earnings loss per S-Hair improved. It went from a bigger loss of 46 cents to a smaller loss of 11 cents. More shares means each potential dollar of profit is spread thinner, but in a loss scenario, it means the loss per share is less severe. They also have stock options and restricted stock units for their employees. As of the 30th of September 2025, they had over 1,000 stock options outstanding. These represent future potential dilution for shareholders if exercised. Digging into the expenses, R&D costs increased to $3.6 million from $1.3 million. This rise is attributed to more consultant spending and higher personnel costs, reflecting their active research efforts for programs like iBio 600 and iBio 610. On the flip side, general and administrative expenses actually decreased slightly to $2.5 million from $2.8 million. This is attributed to lower accounting, consulting and legal fees. Back to the cash flow, operating activities used more cash this quarter a bit, over $5.7 million compared to $3.7 million last year. Simply put, they are spending more money to keep the lights on and fund their research. Investing activities show a spend of $21.5 million, which we saw was mostly for those debt securities. And that massive $46.7 million inflow in financing activities in this quarter. Well, that is the big public offering we talked about. That is what is enabling them to fund everything else. Now, for the big picture on liquidity, they've had significant losses and negative cash flow for a long time. But with that $50 million raise in August 2025, they believe they have enough cash to operate for at least the next 12 months. This is the crucial question for any company like this. Do they have enough runway to get to their next milestone? They think so for now. They are still highly dependent on raising capital through stock sales or other financing. There is no guarantee they'll always be able to do this on good terms, and if they can't, they might have to slow down or even stop development. This is the perpetual tightrope walk for development stage biotech companies. And of course, there are the risks. They admit they have significant losses and may never become profitable. Their future depends heavily on getting their product candidates approved and commercialized, which is a long shot for many. They mention the possibility of government shutdowns impacting regulatory processes, which is a very real concern in today's environment. Their current focus is on developing precision antibodies in the cardiometabolic and obesity space using artificial intelligence. They see a future where their AI platform leads to better treatments, especially for obesity, than current options like GLP-1 drugs. They anticipate their first human clinical trials could start in early 2027. They're developing candidates like iBio 600 and iBio 610, aiming for fat-selective weight loss and improved tolerability. They have also entered into licensing agreements with Astral Bio for myostatin and activin E targets. The company also filed certifications from its CEO and CFO confirming the accuracy of the report. This is standard procedure for these filings. So what is my take on all this? Well, iBio Incorporated is clearly in a growth and development phase. The massive capital raise in August 2025 is a huge vote of confidence and provides them with much needed runway. They are strategically shifting their focus to AI-driven precision antibodies in the lucrative obesity and cardiometabolic space, where they see unmet needs that current treatments don't fully address. Their preclinical pipeline with candidates like iBio 600 and iBio 610 shows promise based on early data. The big risk, as always, is clinical trial success getting FDA approval, and then actually commercializing these complex therapies. The dilution from all those new shares issued is also a major concern for existing shareholders. However, without these capital raises, they simply cannot fund the expensive R&D required to bring new drugs to market. It seems they are making the right strategic moves to position themselves for future success, but only time and clinical data will tell if they can deliver. Alright, that is our deep dive into iBio's latest report. What do you think? Are they on the right track, or is the risk too high? Let us know in the comments below if you found this analysis helpful. Please give us a thumbs up and subscribe for more corporate breakdowns, and join our growing community on Discord linked in the description. Thanks for watching, and we will see you in the next one.